Right, welcome to a weekly S&P 500 ChartStorm run through. What we're going to be doing with this one is just quickly going through the charts and adding a little bit more explanation and context. And before we get straight into it, I just want to direct your attention to this website here, the weeklychartstorm.com. So you can join the mail list there. What I'm going to be doing there is just providing it also via a mail list, so that if you're finding it hard to follow on Twitter, or if you just want it in your mailbox so you can reflect upon it, then you can sign up there. Anyway, into it. So chart number one is a chart of the S&P 500, and this is on a log scale. It's also in nominal terms and price only. Now, I really just included this one for perspective. I've put here this question: notice any similarities? And it is quite interesting that the current market environment here, we've been through this period where it sort of went through this decade-long ranging period. You can see there in the 2000s, happened a couple of times before, so the 1970s, 1940 to 50, and also in the 1920s. Each of those were very, very different situations to what we're in now. So you can't really necessarily say that it's a repeat of that, but it's certainly interesting to note where we're coming from and what kind of things have happened in the past. The other thing to note, of course, too, is these, you have bad things happen from time to time, and the market cycle goes on. Number two is the rule of 7, or this curse of the number 7. And this is that one where, the years ending in XXX7 have had this habit of being, on average, pretty bad. And you can see there that it's particularly skewed by these ones down the low end here, 1937, 1987, particularly angsty times in the market. And, I guess there's two things to note here. First of all, you can see with the spectrum of them that it's not always awful. There's, or in other words, it doesn't always work. Just like the election cycle, just like the seasonality cycle, there's always exceptions to the rule. The other thing is that, if you take the side that it does work, thinking about the year 7, or the fact that this is really a 10-year cycle, kind of lines up with the duration of the business or market cycle. So in many ways, really all this is just a rediscovery of the business cycle. Speaking of market cycles, here we've got a picture of bull markets, and really the bottom line on this one is that if the S&P 500 closes above 2717, then it's the greatest bull market of all time. Now, you could possibly actually make the argument that this 2015-16, twin corrections was the start of a new bull market, and certainly in many respects we saw resets in various indicators, various things like monetary policy around the world. Certainly on a global perspective you could say that. So that's one thing to think about, because that may have been a factor that could be key in extending the life of that market. So yeah, one to think about. But yeah, I guess just the fact that it is such an extraordinary market environment is the key takeaway from that one. On to the next one, number 4. This is the quote common sense indicator. This is S&P 500 divided by the VIX. Now, we can argue whether you quote-unquote should or should not divide the S&P 500 by the VIX, but still producing quite an interesting conclusion. Now, also I would note, actually, that the way that he's displayed it here as a, kind of deviation from trend kind of model is one way of getting around that, the contention that these are two different types of series. And indeed, he showed it separately, can't really see it as well on this chart, but in 2000 peak and the 2007 peak, this indicator was at the time on both of those instances was 4 standard deviation stretched to the upside, and being 4 standard deviation stretched to the upside once again, that would be something that you tend to increase the risk or the odds of something bad happening. And on that note, looking at a very similar indicator, the CBOE Implied Correlation Index. This one here is shown inverted. Now, the index itself just gives a gauge of average correlations based on option pricing. So very much a sister index to the VIX or the SKU, which we'll talk about next. And this one, there tends to be, or appears to be, a contrarian signal being generated. So, whenever you get spikes in correlations, remembering again that this indicator is shown inverted, upside down, it tends to line up with a market bottom. That makes sense because, when there's a market panic, correlations tend to converge to 1. The other thing is too, I guess, looking at market structure, the rise of passive funds, the rise of index investing, whenever you get a bit of panic, that tends to drive very indiscriminate selling. So, if you sell the index, you're selling everything. And looking at it on the other end of things, so at a market top, crunch down and correlations can be driven by, I guess, 2 key factors. One would be that all the returns are being driven by 1 or 2 sectors, so you have a bubble in 1 or 2 sectors. The other would be that, early weakness may be showing up in, a couple of sectors. As I flagged, the SKU index, so this is again a option derived series. The way it's described is kind of as a gauge of the likelihood of a black swan event or a non-normal distribution. And another interpretation of it is that it's a loose proxy for tail risk hedging demand. In that respect, provides another angle or view of market sentiment. The fact that it's on a steady upward path against also a steady upward path in the market is very informative in that respect. I guess reflecting a steady rise in concerns about things like valuation. And also, generally since 2009, 2008, we've seen a rise in demand, certainly at the institutional level, for tail risk hedging strategies. Looking at the individual spikes here, you can see that it tends to spike, around key events. You can see the big spike during the Brexit, big spike during the election, and even just, during sort of market indigestions. Interesting then that we're seeing a bit of a spike here at the moment. Number 7 is the Bearish mutual fund assets, or the RIDEX Bearish funds. Now I guess this is another one where we've got a couple of points to raise. First is that these assets will have been steadily eaten away by negative returns because, if you're running a bearish strategy and the market keeps on going up, you are going to be feeling pain. So that's, that would have seen quite an erosion of assets just based on market returns. And also a bit of capitulation aspect driving it as well. Tends to work as a contrarian indicator. You can see there that it ran down to very low levels around the 2015 micro market top, if you want to maybe call it that. Moving on to number 8, this is equity allocations of US households. And how this is calculated is it's showing direct and indirect holdings as a percentage of financial assets. Now, the thing to note about that is, it's a percentage of financial assets, so it's not a true allocation in the sense that, it doesn't bring in things like real estate or other assets, so, it doesn't present a full picture, but very notable that it is back towards these 2000 levels, and, where it goes from here is anyone's guess, really. Because at this sort of later stage of the cycle, a lot depends on these, quote unquote animal spirits and, people can get carried away. So it's going to be a very interesting couple of years indeed, either way. Number 9, the spin cycle. It's a bit of an interesting chart here. Shows the performance of spun-off companies. And you can see there that they've done very well. So, you know, very good for the companies that spun off. I don't know what happened to the ones that, you know, were the origin of those spin-offs. Might be another interesting one to look at, you know, relative performance there. But yeah, I guess it goes to show that there can be some pretty good opportunities coming out of those kind of M&A activities. And the final one, FinTech. Bit of a overused buzzword. There seems to be, you know, a proliferation of FinTech entrepreneurs these days. Don't know how many of them will actually come up with anything, you know, that turns into a meaningful business, but we'll have a look at this one here. Shows you the percentage contribution or percentage point contribution to rolling 12-month returns of each of the sectors. You can see there that the bulk of returns are being driven by financials and technology. Always worth paying attention when, you know, it's one or two sectors driving the bulk of returns. And certainly one aspect of that is the fact that combined they comprise, I think it's about 42% of overall market cap. So whatever's going to be whatever's happening to these two sectors is always going to be very important. But you know, the fact that it is increasingly being driven by these two sectors is something to pay attention to, and is probably a good place to end it. Something to think about and ponder and muse upon until the next episode.